Nerina, as Alicia said, we started the week off on a strong note after that G20 meeting at the weekend where finance ministers indicated there would be an orderly unwinding of all that stimulus in the economy. But it seems that scepticism is growing as the week progresses, and we've seen a bit of a pullback in equities.
Yes, certainly. I think what we're finding is that maybe many investors are looking at the very good run that we've had since the lows of the market in March. Most indices up in excess of 40%, certainly our local indices, and maybe saying, you know what, it's been a good run. Maybe it's time to start taking money off the table, and maybe what we're seeing is just a good consolidation phase after what's been an exceptional run in the markets overall.
Do you think there is a bit of concern about early withdrawals of those stimulus packages?
No, not necessarily. I think we had the Fed yesterday again reiterating that rates will remain at these historical low levels for much longer. And I do believe that's certainly providing a very strong base for the market at the moment. So I don't think that there's really major concern about those markets or those central banks that are starting to talk about quantitative easing. So I don't think that's really causing any of the consolidation that we're seeing at the moment.
So although we have seen interest rate hikes in some countries already, such as Australia, Norway, Israel, they really seem to be out of kilter with the rest of the world at this stage, don't they?
Yes, very much so. I think the major markets are all still at relatively historical lows. There's still a lot of excess cash around, still a relatively good risk appetite. I think the market is really just looking for some more direction at the moment. We've had lots of economic reports out, we've had lots of earnings reports out in all parts of the world. The market needs time to digest this, and at the moment there's not really clear direction what the next move should be. We've had a couple of very good days and maybe just time to consolidate at current levels before it takes its next major move.
Of course, as you said, a pretty quiet day on the economic and the company front here in South Africa today. We did have quite a slew of results yesterday, and particularly from retailers and from other industrial stocks. PPC results out yesterday, a 40% fall in headline earnings per share. Of course, that's included a charge for its empowerment transaction. And of course, those results really overshadowed, I should imagine, by news that it is complying with the Competition Commission on its investigation into the cement industry.
Yes, I think although the results for PPC were down from the previous period a year ago, I think it was certainly in line with what the market was expecting, and the market took heart from these results. A couple of very good signs in it, for example, the fact that some of their capex plans have been pushed out from FO10 to F11, which is certainly good for the dividend for the company. I think the fact that they came clean on the collusion also has been very good. Important to notice there that it was about geographical segmentation that they colluded. This was not about price fixing. And although this is still, of course, anti-competitive behavior, it's quite difficult to quantify the impact on the end user and on the consumer. So it'll be interesting to see what the ultimate fine is that is imposed on them. But I think after the raid at the offices of PPC and the other three companies with him in the cartel in June, the market took quite a dim view of this, and maybe they were expecting this to come out much worse, and the market certainly took heart from the results and from the admission of guilt yesterday from PPC.
Well, we had those results up from Mr. Price and also from SPAR, and the market really seeming to like those, pushing their share prices higher. And of course, over the past few weeks, we've seen results up from other retailers, also some trading updates. We've had JD Group, Lewis, we've had ShopRite and Pick n Pay, all in the recent past. What are you seeing from our retailers at the moment?
I think what we're finding in terms of the retail space is that obviously some very tough trading conditions. We don't need to look very far to know that the South African consumer is still finding themselves in very dire straits. But within the retail space, we see some very interesting trends developing. It's been a very good period for the food retailers, obviously very defensive during a time of decline in the retail space. But looking forward to the next 12 months, we expect them to be relative underperformers in this space, for the simple reason that food inflation has now declined to single-digit territory, 4-5%, probably not going to be able to achieve turnover growth of much more than 6%. So companies of the likes of SPAR, who reported results yesterday, are certainly still experiencing margin squeeze. So certainly not the best type of retailer to be in. If we rather focus then on the likes of Mr. Price, we see some very interesting trends developing there in terms of cash versus credit retailers. In terms of the consumer, we're finding that most of the spending is coming on the back of cash, real discretionary spending that has eased up in recent months on the back of the interest rates that have declined, the petrol price that have eased somewhat. And it's interesting to see that it is the cash retailers that are certainly doing better rather than the credit retailers. So if we look at somebody like Foschini, for example, a lot of their growth really came from growing their book, which certainly is not very good earnings growth. Whereas if you look at Mr. Price, positioned themselves very, very well in terms of their offering. They certainly surprisingly seem to do very well in the LSM 7 to 10 category, and in that sense are faring very, very well both in terms of cash and in terms of the offering that they have for the clients. So certainly our preferred pick in this sector.
Well, just to close, British American Tobacco, that's one of these anomalies in the local market, one of the biggest company, but not included in the indices, of course. Some potentially negative news coming out regarding tax in the European Union for BTI.
Yes, it's not a major story for them, but I think an interesting trend that we see coming from the European Union. There were some guidelines on EU tax and excise duties in terms of cigarettes that were agreed upon yesterday. And the interesting thing is that this influences mostly the new member states. So if we look at what is required out of these, although the excise duties could be going up by as much as between 40 and 50%, many of the existing member states are already compliant with these new excise guidelines, which are due to be implemented by 2014. But if you look at some of the emerging European economies like Romania and Poland, they would have to be increasing cigarette prices at the till by up to 50% in order to meet these excise guidelines. Now, for British American Tobacco, that is certainly one of the strong growth areas, and although it's a relatively small portion of their market, so we don't expect it to be a major impact on the bottom line, it is an interesting trend for us that these tax guidelines and changes in excise duties do bring in an impact in some of these companies, global companies that operate in the emerging markets.